When it comes to improving your financial health, the first advice most people get is to invest in a mutual fund. Now, mutual funds are actually great investment avenues to beat the returns of FD and simultaneously have the quality of diversification to keep your money safe as well. But even today, a lot of people do not have the confidence to invest in mutual funds, and the reason for that is they do not have any idea as to which mutual fund to choose from and how much return can they expect by investing in these mutual funds. So in today's video, we will be talking about what mutual fund is, what are the different classifications of it, what are some of the advantages of investing in mutual fund, and what are some of the key criteria you need to keep in mind before investing in them. Hi everyone, my name is Harsh Srivastav. On this channel, I throw light on topics such as stock market, real estate, cryptocurrencies, insurance, and much more. So if you are new here, do hit that subscribe button and click on the bell icon so you don't miss out on any of my future videos. Let's get started. So you ask, Harsh, what actually is a mutual fund? Well, mutual fund is an investment company that pools resources from a lot of investors and then invests that money in different financial securities such as stocks, debentures, government bonds, corporate bonds, and whatnot. But what do these mutual funds get in return? Well, mutual funds charge an expense ratio which is used to cover all the operating expenses as well as the management fee of the fund. So if there is a manager kept to decide which security to buy, which security to sell, he'll be paid a certain salary. If the fund has to grow itself, the fund has to be marketed, so more and more people can pool in the money. So there are marketing expenses involved as well. So expense ratio is used to cover all the expenses that are related to the mutual fund. Now, just like stocks, even mutual funds can be sold in units, and each unit can be bought at the NAV. What is NAV? NAV is the net asset value, which is the unit price of the mutual fund scheme. So now you know what a mutual fund is. Now let's classify mutual fund in two ways. The first way is lock-in period. There are open-ended funds and there are closed-ended funds. Open-ended funds are those funds which do not have a lock-in period or a maturity date. So you can invest your money in open-ended funds at any point of time, and even you can redeem the money at any point of time. On the other hand, in case of closed-ended funds, you can invest the money through a new fund offer, and also there is a maturity date. So your money gets locked up in the fund until the maturity date. But now you may say, Harsh, my money is going to get locked up, so I'm not gonna invest in closed-ended funds. But there is actually a solution for it. Most closed-ended funds are traded in the open market. So if you want to exit or liquidate your investment, that is actually a possibility even in case of closed-ended funds. The other classification is management of the fund. There are actively managed fund and then there are passively managed funds. Now, actively managed funds are those funds where the portfolio is actively churned by the management team. The management team takes the decision of which securities to buy, which securities to sell, and which securities to hold. And typically, the purpose of the actively managed fund is to beat the returns of the market. That is Sensex or Nifty. And this is the reason why you will see that actively managed funds have higher expense ratio. Now, what are passively managed funds? Passively managed funds are those funds which do not have a separate team to decide which stock to buy, which stock to sell, and which stock to hold. Instead, these funds follow a certain market index such as Nifty or Sensex. And the purpose of these funds is not to beat the market, but match the returns of the market. So if Nifty is able to get 15% return, what return would you ideally get from a Nifty index fund? 15%. Now, because there is no separate management team, investing in passively managed funds becomes a lot cheaper because of the lower expense ratio. So now that we have classified mutual funds, now let's talk about the advantages of investing in mutual fund. The portfolio in mutual funds is handled by experts. So even if you do not have the know-how of which stocks to pick, you pay just a small management fee to these mutual funds and you get exposure to a portfolio of stocks and bonds and get great returns on it as well. So once you have put money in mutual funds, everything is taken care of by expert fund managers. Talking about the risk, mutual funds invest your pool of money in multiple stocks and bonds. What this does is it reduces the risk by diversifying your investment. So even if one of the company dies or some bond defaults in paying you the money, the other securities will help to recoup the losses and even grow your money. There is also fair pricing and convenience in investing in mutual funds. So mutual funds are traded once at the NAV. So there is no price fluctuation during the day. Also, mutual funds are convenient to buy and sell. You do not have to follow up with any stockbroker. You can simply go to any mutual fund app and do a KYC and start investing. Mutual funds also come with a lot of investment flexibility. There are different schemes in mutual funds which match different investment objectives. Investors have the option to invest small amounts of money in the form of SIPs, or even if they have a large sum of money, they can do it through a lump sum investment. Lastly, the biggest advantage of investing in mutual fund is there is investor protection. So the operations of mutual funds are regulated by SEBI and there are regulatory provisions made in the interest of investors. The mutual funds also release a scheme document which mentions the investment strategy of the fund and the portfolio allocation. So these are some of the advantages of investing in mutual funds. Now let's talk about 4 crucial factors you need to look into before investing in mutual funds. The first factor is returns expectation. The returns on mutual funds can vary by a lot. It depends on the type of mutual fund you choose. So if you choose equity oriented mutual funds, they invest in stocks of companies. So typically in the medium to long term, the returns are quite high and definitely more than fixed deposits. Now there are debt oriented funds as well. These debt oriented funds invest in fixed income securities such as debentures, corporate bonds, government bonds, etc. They are able to provide stable and regular returns, but the returns are usually lower than that of equity oriented funds, but most of them are able to beat the returns of fixed deposits. Now there are also some investors who have unused money in their saving account. So they want to earn at least better returns than the saving account. So there are liquid funds for that and it is very ideal for them because they invest in money market instruments. Now the second factor is investor risk appetite. So if there is a person who is close to his retirement, in that case, he will need regular funds after retirement. So he should ideally put most of his money in debt oriented funds and maybe keep 20 to 30% of the money in equity funds. So the debt fund can help to meet the liquidity requirement and the equity fund can help to grow the money. On the contrary, think of a person who is 28 years old. He has no responsibilities and has a decent regular income as well. So in that case, even if he decides to put 100% of his investment in equity oriented schemes, it is completely fine because he actually has the risk appetite for it because of being young and having a regular income. Now the third crucial factor is the expense ratio and the exit load. Now we know that mutual funds levy an expense ratio to manage the fund. So typically what would be to the benefit of investors? A lower expense ratio. So as we talked about, index funds are great for people who are looking for lower expense ratio because they are passively managed. Also, many mutual funds levy an exit load. What is an exit load? It is an amount of fee that you need to pay because you are withdrawing the money before a certain period of time. So one should keep in mind that the time frame for the exit load is not too big. The fourth crucial factor is the fund size. The AUM, that is assets under management, denotes the size of the mutual fund. For large cap equity mutual funds, the return generation ability is more important than the fund size. On the contrary, in case of small cap equity mutual funds, there is a limit to the amount of cash influx beyond a certain limit. So, a lower asset under management is preferable in case of small cap equity mutual funds. In case of debt funds, the higher the AUM, the better it is. Why, you may ask? Because then the expense of the mutual fund can be distributed among all the investors and the expense ratio of the fund can be lowered. So these were the 4 crucial factors you had to look into before investing in mutual funds. So as I had promised, there is a bonus point for you. But before that, like the video and click on the subscribe button. When you invest in mutual funds, you will see that the fund schemes have a direct plan as well as a regular plan. So the regular plans are actually sold by stockbrokers, insurance agents, and many other people who want to earn commissions on the mutual funds sold. This increases your expense ratio and has a major impact on your returns in the long term. So what is the solution? You should always try to buy direct plans of mutual fund schemes. Thank you so much for watching. If you have a knack to invest directly in the stock market, watch my video on how to analyze a stock and invest in the stock market.